Good afternoon, everyone. I'm Tim Mischling, Research Associate with the Citizens Research Council of Michigan. I'd like to welcome you to today's webinar, offering perspectives on Michigan's personal income tax. Perspective on state budget pressures. We published a paper on the challenges state policymakers will face in the near future balancing the state budget a week and a half ago that's garnering a fair amount of attention from newspapers, radio and television, and from concerned citizens. We scheduled today's webinar to walk you through the findings of the study and answer any questions you might have. The Citizens Research Council of Michigan is a statewide, nonpartisan public affairs research organization. This is the Research Council's 100th year of operation, a longevity we attribute to our promotion of sound public policy for state and local governments through accurate, independent, and objective research. We are a private, not-for-profit entity, and we rely on the charitable contributions of foundations, businesses, and corporations. I'd like to encourage all of you to join our circle of supporters and help us continue to provide quality, independent information on important policy topics in Michigan. You can learn more about the Research Council by visiting www.crcmich.org. At the right of our website, you'll find an opportunity to sign up for our email distribution list where you can be notified about newly released publications. Our presenter today is Jordan Newton. Jordan is a recently graduate from the Masters of Public Policy program at Michigan State University. He has a Bachelor of Arts degree in economics from Gonzaga University. He is starting research with the Citizens Research Council, focusing on state affairs. Please note, we are recording this webinar and will post it on our webpage where it will be available for future viewing. Second, we have everyone but the presenters on mute, so we will not be able to hear you if you speak. To ask a question, please type the question into the questions panel that should appear on your screen. You can type these questions at any time throughout the webinar. If you have any technical problems during the webinar, please let us know by calling 734-542-8001. After the webinar, you'll receive an email soliciting your feedback, and we'd very much appreciate any feedback you may have. With that, we'll begin the presentation.
Thank you, Tim. What the state's budget agreed to in July had enough room left over to make payments to the Budget Stabilization Fund, make payment on the teacher pension system, and didn't require major cuts for core services. Future budget negotiations.
Thank you, Tim. Can you hear me? Okay, perfect. Thank you, Tim. While the state's budget agreed to in July had enough room left over to make payments to the Budget Stabilization Fund, make a payment on the teacher pension system, and didn't require major cuts for core services, future budget negotiations might be a little more difficult. Between past decisions to divert revenue to priorities like improving the state's transportation infrastructure, costs of programs like the Michigan Indigent Defense Commission, and other items that are less directly in the legislature's control, a coalescence of factors could make putting the budget together more difficult in coming years. Today, I will give a brief overview of the state's current financial situation and outline some of the upcoming budget items that will require some tough decisions by the legislature for the next decade or so, and look at the potential cumulative effects. Today, I will give the state budget for fiscal year or FY 2018 is $56 billion. This includes all state revenue as well as federal revenue sharing measures like Medicaid grants and other federal programs administered at the state level. The majority of that money goes to the state's two primary accounts, the School Aid Fund and the General Fund. The School Aid Fund is the primary vehicle through which the state provides assistance to local school districts and the public school employee retirement system. The second account, the General Fund, is divided into two types of accounts in practice. Dedicated purpose funds, which are earmarked or directly attributed to purposes outlined by the funding mechanism, and the General Purpose Fund, which is the state's principal operating fund. General fund general purpose money can be used to fund any and all government expenses. The general fund general purpose component of the budget is $10 billion for FY 2018. This means the state decision makers only have wide-ranging discretion over about 18% of the budget. Note that from here on out, when I refer to the general fund, I will exclusively be talking about the general fund general purpose portion, as it is the primary focus of this analysis. As the chart on screen shows, general fund revenue is expected to see slow growth over the next few years. While the state has recovered from the recession, collections of the general fund have not seen the same level of growth that it has in previous periods. In fact, when accounting for inflation, general fund revenues have remained close to $8 billion in 2006 dollars. This means that, under current projections, legislators will be working with a pool of resources that is staying the same size. Because the general fund is the principal operating account, any new priorities that arise over the next few years will have to compete for resources with existing programs. The majority of general fund revenue comes from the personal income tax. The income tax is unique because it is the only major revenue source that primarily goes to the general fund. For example, more than 70% of the sales tax revenue is directed towards the school aid fund. This means the general fund is heavily reliant on the income tax. Beyond the income tax, about 12% of general fund revenues come from the use tax, 8% from the corporate income tax, 6% from the sales tax, and the remaining revenues come from a mix of smaller revenue streams. Because the general fund relies so heavily on the income tax, it is very vulnerable to swings in income tax revenue. The chart on screen shows that annual collections for 1 percentage point of taxable income, as well as national recessions. As you can tell, during recessions, income tax collections drop considerably. History shows that an economic downswing from 5 to 25%, which would translate between a 4 and 20% decline in general fund revenues today. To begin looking at the problem, there are a number of revenue diversions that will prevent general fund revenue from growing in future years. Do note that these items are accounted for in above budget projections. To start are the Michigan business tax credits. While the Michigan business tax, or MBT, was replaced with the corporate income tax in 2011, many companies were allowed to continue filing their taxes through the MBT to claim tax credits from existing agreements until their credits expired or are used in their entirety. The tax credits provided in these different agreements are refundable, meaning if the value of the credits exceeds the value of the company's tax liability, the state is responsible to pay the value of the remaining credits. The largest tax credit program under the MBT is the Michigan Economic Growth Authority, or MEGA tax credits. They were provided to incentivize business activity in the state. These agreements last up to 20 years, so the state will be liable for at least some money on the MEGA credits until 2032. The state has spent more than $500 million on these credits annually. Payments are not expected to drop below that level until 2029, but projections are a little tricky. Some credit agreements will be more expensive than others, and the state's cost in FY 2012 to FY 2016 exceeded early projections. While the remaining tax credit programs do not drain the general fund quite like the mega credits, there are still a few other agreements worth talking about. The brownfield tax credit, a credit provided to incentivize development on sites that are either environmentally contaminated or perceived to have environmental contamination, will run for the next 6 years. If these credits exceed their tax liability, companies can either sell them to another company or receive 85% of their value from the government. In all, it is expected to cost the state almost $6 million annually. Farmland preservation credits are provided to incentivize landowners from converting farmlands into residential or commercial property. These agreements last up to 90 years and can be extended upon their expiration. The state spends $1.5 million annually on these credits. The polycrystalline energy credit provides tax relief for solar energy production. The agreement lasts through the 2022 tax year and will lower annual revenues by an average of $20 million. And finally, the Renaissance Zone tax credits are offered to incentivize developments in targeted areas of the state. These credits are expected to reduce revenues by an average of $3 million over the next 6 years. Collectively, these agreements are expected to cost the state more than an average of $600 million through 2022 and more than $500 million until 2029, when a large portion of the mega tax credits are set to expire. In total, the state is liable for more than $9 billion over the next 15 years. That number could increase if the value of the remaining mega credits are higher than expected. While these credits are already showing up on the books for the general fund, they limit the decisions the legislature is able to make. The state is not able to avoid these agreements, and they reduce general fund collections by more than $500 million each year. The next major diversion worth noting is the transportation funding package. In 2015, the legislature agreed to a long-negotiated plan to increase funding to repair the state roads by more than $1 billion. The transportation funding package contained two provisions that will start to affect general fund revenue in the coming years. First, the transportation agreement will divert $600 million in revenue from the general fund to the Michigan Transportation Fund annually. These diversions begin in fiscal year 2019 with $150 million, then increase to $325 million in FY 2020, and then peak at $600 million in FY 2021 and thereafter. The second change that affects general fund is the expansion of the homestead property tax credit, a tax break for low-income taxpayers who own their own homes. The tax credit expansion was designed to offset the increase in fuel taxes and registration fees due to the other components of the transportation package. The expansion raised the maximum value on property that could be claimed, increased the income threshold for eligible taxpayers from $50,000 to $60,000, and reduced the percentage of income that must be paid in taxes before benefits kick in. The credit expansion is scheduled to begin in 2019 and is projected to reduce revenues by a little more than $200 million annually. Once fully phased in, the transportation package will lower the general fund collection by just over $800 million. There is no increase in collections to offset these revenue reductions. The initial plan was that the general fund growth would offset the costs down the line. As we approach the initial phase of diversions, it remains to be seen how the legislature will reconcile the increase in revenue diversions with the general fund budget. The next item on the docket is the state's personal property tax reform. In 2014, the state exempted certain industrial and commercial property from the personal property tax known as the PPT to improve the business climate of the state. To make new exemptions under the PPT palatable for all parties, the final reform included reimbursements to both local governments and the school aid fund, the two primary beneficiaries of property tax revenues. The PPT reform included a phase-in for property to become exempt, where all new eligible industrial property and eligible property more than 10 years old became immediately exempt, and all other eligible property would become exempt once it reached 10 years of age. In addition, the state created the Essential Services Assessment, or ESA, which collects a fraction of the PPT revenue on the personal property that was made exempt. As you can see, however, the ESA collects a relatively minor sum compared to the personal property tax on the same property. Despite the increase in revenue from the ESA, the net reduction in revenue for the general fund is expected to reach nearly $500 million annually by FY 2023. Revenue shared with local agencies is also scheduled to increase with an inflationary adjustment, which means state payments will increase as time goes on. The lost revenue from the reform effort was intended to be offset by declines in MBT tax credit expenditures. Under more recent projections of MBT tax credits, however, there is a large overlap between the initial loss of revenue due to PPT reform and higher levels of MBT tax credits. As the chart on screen shows, when you ignore the uncharacteristically high MBT collections from 2016, the combination of costs from PPT reform and revenue diverted from MBT credits remains over $1 billion through 2028, when MBT agreements begin to taper off. This will add further pressure to the state budget. There are also possibly two major changes in healthcare tax policy that could cause significantly reduced state revenue. The first is the termination of the Medicaid Managed Care Organization use tax. Until 2015, the federal government allowed states to levy a use tax on Medicaid MCOs, which exploited a loophole as the revenue from those taxes was returned to organizations as state Medicaid spending, which triggered additional federal money. In essence, the tax allowed the state to earn federal matching dollars off of net zero spending as the money was returned to the agencies they collected it from. In 2015, the federal government decided to close this loophole and told states that use taxes on Medicaid MCOs must be removed by the end of 2016. The use tax was responsible for about $250 million yearly in general fund revenue and brought in additional federal matching dollars. The closing of the loophole triggered an increase in the Health Insurance Claim Assessment, or HICA, rate, which is the tax levied on paid healthcare service claims. The rate increased from 0.75% to 1%. This offsets a portion of the revenue lost from the use tax, but creates a secondary issue. The HICA tax is scheduled to sunset in 2020. If this happens, the combined annual loss of revenue would be around $500 million. The legislature has already extended HICA once. Extending again is within the realm of possibility, but would still leave declines due to the expiration of the MCO use tax. In addition to the major revenue reductions discussed above, a few relatively smaller reductions are also scheduled to hit the books in the next few years. A 2014 decision to phase out the driver responsibility fee, a punishment for those convicted of reckless and drunk driving offenses, is scheduled to start reducing general fund revenue this year. Once fully phased out, more than $48 million in annual revenue will be lost. The state issued limits on the liability the state could impose on corporate officers of companies that default, which will reduce annual revenues by more than $60 million. The phase out of the tax on the difference, a provision that requires individuals to pay the sales tax value of a vehicle trade-in, will also reduce revenues. While the acceleration of the provision was vetoed by Governor Snyder and awaits its fate in the legislature, the current schedule will reduce collections for the general fund. It is estimated that the difference will be $12 million a year by 2023. Over-the-counter medications and data center equipment were exempted from the use and sales tax. Those exemptions will reduce general fund revenue collection by $10 million, losses for the school aid fund. In addition, collections from the sales and use tax from aviation fuel will now be partially delivered to the state aeronautic fund, which will reduce general fund collections by $8 million this year, and that will increase to $15 million annually by 2023. All told, when examining all new revenue sources and declining revenue sources, Michigan will be facing an increase in diversions from the general fund that is somewhere between $1.5 and $1.8 billion from 2015 levels, depending on whether HICA is allowed to expire. By 2021, more than $2 billion of potential general fund revenues will be diverted to other purposes. It will represent about 20% of the size of the general fund today. As such, general fund revenues are expected to increase less than 5% from 2015 levels. Once inflation is factored in, this means that the pool of money available to the general fund is expected to decline. In addition to the building revenue pressures, some spending level pressures are beginning to emerge that will add to the revenue side issues. In a step to take advantage of the increased federal Medicaid expansion money, the state developed the Healthy Michigan Plan. The Healthy Michigan Plan expanded the number of people covered under Medicaid in the state. In addition to the federal government footing the entirety of the bill for the first few years, the Healthy Michigan Plan saved the state money it was spending on prisoner health care and mental health services. At its peak, the expansion saved Michigan more than $400 million in general fund spending. Based on the original expansion, states are required to start to pay Medicaid expansion starting in 2017. This means Michigan is required to pay 5% of the total costs this year, escalating to 10% by 2020. As state-level costs ramp up, the state has two choices: either pay the state share of the expansion or end the program in its entirety. The problem for the state is either option requires the state to spend more money on healthcare. If the expansion were to end, the state would need to pay costs for prisoner and mental health services the Healthy Michigan Plan is currently paying. Otherwise, the state must pay its federally mandated portion of the Healthy Michigan Plan. The legislation explicitly states that the program will end when it costs the state more than it was projected to save. Initial projections show that will occur after 2021. Regardless, the state will be looking at hundreds of millions in increased spending from 2016 levels in the next few years. Because the state public defense services were widely seen as insufficient, the legislature created the Michigan Indigent Defense Commission to oversee local government's provisions of public defender services. The Indigent Defense Commission has the authority to issue new regulations that local governments must follow when providing public defense. But because these are state mandates, the Headley Amendment to the Constitution, which includes a provision that outlaws unfunded mandates for local government spending, requires the state to increase its share of the cost, or its spending to match shares of costs. Early estimates put the state share of public defense costs at $50 million annually. However, as new standards are set, these costs are likely to increase. In addition to changes based in law, there are a few long-term challenges that the state must address. One of the changes that has drawn the most public attention is the state pension system. Due to assumptions in retirement length and return on investments that resulted in lower than required growth, the public school employee pension system has an unfunded liability of about $27 billion. While education spending is not traditionally a general fund expenditure item, history shows that costs can trickle from the school aid fund to the general fund. In fact, $255 million of the most recent general fund budget was diverted to make payments on the pension system. As the state pays down the liability, the general fund could be targeted to help prevent declines in funding in the classroom. Michigan also has growing needs in the classroom. As the United States and the world advance technologically, classrooms need to make sure they are giving students the tools they need to be effective in the modern economy. Unfortunately, Michigan's classrooms are declining relative to the nation. Not only is Michigan in the bottom half of the country's in test scores, almost every other state is improving at a faster rate than Michigan. The 21st Century Michigan Education Commission, the commission Governor Snyder created to examine education policy in the state, sees a need to revamp education spending. Their recommendations are likely to total well over $1 billion in increased spending. While there is no current plan to act on these recommendations, and it is relatively unlikely that they are all implemented, it provides an idea of the scope of what the state might need to do to ensure students are able to prosper in the modern workforce. In addition to education needs, the state is in need of a large infrastructure overhaul. The 21st Century Infrastructure Commission, also created by Governor Snyder, found that roads, bridges, water systems, and telecommunication networks across the state are in fairly rough shape. While the $1.2 billion allocated by the transportation funding package is a start, the commission said that $4 billion a year is needed to repair failing infrastructure in the state. Like the Education Commission's recommendations, these are just that, recommendations, but other challenges will arise if infrastructure problems are left unaddressed in the long term. There are a few additional things to note that will make balancing the state budget a little more difficult in the coming years. The first possible hurdle is the state's heavy reliance on earmarking. Earmarking is the process of dedicating revenue streams for specific purposes prior to the budgeting process on a specific dollar or percentage of revenue basis. This can be done through the legislature and through the state constitution. Nearly 2/3 of all tax revenue in the state was earmarked. Federal revenue sharing is also generally earmarked for specific purposes. While many of the dedications are able to be altered by the legislature, as they are directed based on legislative created rules, opening up tax statutes to change where revenue flows go could be a difficult proposition. In addition, this means that increases in tax revenue might not reach the general fund if those increases are in a tax that is heavily earmarked. While the Consensus Revenue Estimating Conference believes that the sales tax is increasing faster than initially projected, most revenue from the sales tax is directed towards the school aid fund. This means that less than 10% of the increases are seen in the general fund. Given weak projected growth in the income tax, the largest tax primarily directed towards the general fund, earmarking will pose a challenge to revenue distributions. Two changes in the income tax will also likely reduce revenues in the long term. The first is a capping of the income tax revenue relative to inflation. As part of the transportation package, the state limited income tax growth to 1.425 times the rate of inflation. Starting in 2023, If income tax revenue grows by more than that, in instances when inflation is positive, the rate will receive a permanent cut. There is also no long-term mechanism for the rate to rebound. So if the tax rate declines one year and then revenue falls to traditional levels the next, the tax rate will remain at its new lower level until the legislature votes to change it. In addition, the size of the personal exemption increased. The new exemption is indexed to $3,700 in 2012 or $4,000 in the given year, whichever is greater. Once the indexed value level is greater than $4,000, the exemption will begin to increase annually and will reduce income tax collections by millions each year. Revenue is expected to decline by $115 million annually by the year 2023. Uncertainty at the federal level will compound the above risk factors for the state. To start, changes in the federal budget moving forward are tough to predict. The one common theme amongst the majority of executive budgets and congressional offerings has been a shift of federal government handing a larger spending role to state governments. This uncertainty alone can put pressure on the state budget, as decision makers must plan for the possibility of revenue streams drying up. While there is no guarantee any individual changes happen, the fact that these trends appear could complicate a state budget situation that will be in murky waters moving forward. The largest of proposed cuts come from two state-administered federal programs, the Supplemental Nutrition Assistance Program, also known as SNAP, and Medicaid. For SNAP, which is formerly the Food Stamps Program, there have been discussions of requiring states to pay a much larger share of the costs, up to as much as 25% cut in federal funding, and requiring states to increase their share to receive federal money. Michigan currently receives $2 billion annually for the program. Early projections show that the state could be responsible for nearly $4 billion over the next 10 years if some of the more sizable cuts come into effect. In addition, the federal government has looked into reducing Medicaid spending. The state currently receives more than $13 billion annually to operate the program. Small cuts would have large ramifications for the budget. Any sizable reduction could see the state be required to make tough decisions. Smaller programs have also been discussed as potential places for the federal government to save money. Environmental programs, like the Great Lake Restoration Initiative, and grants that provide large shares of funding for the state's Department of Environmental Quality, have been discussed for reduction. Core education programs, including teacher training and after-school programs for low-income students, could also see cuts. In addition, the Department of Housing and Urban Development could lose funding for the Community Development Block Grant, a program that provides millions in funding for homeless shelters, senior transportation, and preventing blight issues for Detroit. And a program that provides heating credits for low-income households also could be ended entirely. This provides $175 million annually in tax credits for low-income individuals. All told, cuts to these and dozens of smaller programs could reduce spending in Michigan by billions of dollars. With large cuts to Medicaid and SNAP, they could reach as much as $2 to $3 billion. These cuts would leave the state with tough choices. Does the state attempt to replace federal money while reducing funding from existing programs? Does the state leave everything as is? Or does it cut programs that lose federal dollars entirely and use those resources elsewhere? While there are many possibilities from what might get cut and what could get done, it will leave the state legislature with unenviable choices should the worst of it come to pass. Moving into the start of the 20s, the state could be in a precarious position. Under good economic conditions, the state is likely to see minimal growth in the general fund. If things take a turn for the worse, some difficult choices could be forced on the budget. With somewhere between $1.5 and $2 billion worth of diversions from the general fund and planned increases in spending added on to that, the total level of state revenues that are available are not likely to change significantly over the short term. This means that, under the best of circumstances, new priorities like improving water and sewage systems, increasing education spending, or other potential issues that might arise will be competing for a pool of resources that will not be growing. not to mention growing needs from existing programs. Before considering the effect of potential federal cuts on the possibility for an economic downturn, more than 20% of the general fund will be tied down due to revenue diversions and spending pressures. Federal cuts could easily remove hundreds of millions to billions in spending from the state, but it remains to be seen what the exact effect will be. And any economic downturn would both cut available funds as tax revenues decline and increase demand for services, which would put even more pressure on the state. Taken as a whole, the state budget could enter a turbulent period moving into the early 20s. And with that, I'll turn it back to Tim for any questions that you may have.
Thanks, Jordan, for that great presentation. We have a couple questions that have come in. If anyone has other questions, feel free to type them. There's still time. So to start out, Jordan, you said that we know pressures in Michigan will create a $2 billion amount of funding, and the federal level could increase that. How much will additional pressures be created by a recession?
It depends on the severity of the recession. So a recession that is similar to the recessions we experienced in the early 2000s and 2008 could reach as much as 20% of the general fund. History shows that income tax revenues decline about 25% under large recessions. Smaller recessions could mean as little as a flattening of income tax revenues, or a decline of up to 5%, which would be about $500 million to $1 billion if it's a smaller recession. A larger recession could be up to $2 billion.
Is there any predictability in the MBT credits, or are the numbers that we have just best guesses?
There is a lot of predictability. The one caveat to that is there are questions as to when those credits will be claimed and actually distributed. 2016 is a good example of when things can kind of go a little bit awry in that the state had over 900 million in credits come in for that year alone, when it was expecting around 650 million in credits. So the total value of credits available and the general timeline makes it predictable, but in any given year, there could be a decent size amount of variation.
Will the general fund pressures you identified in your report affect the funding for schools, either directly or indirectly?
It has the possibility to indirectly. As stated, because the school aid fund is separate from the general fund, a lot of the direct pressures will not apply directly to school funding. It will apply to general fund spending for schools that exists now, so there is a little bit of a direct effect, but the larger section is the ability for the general fund to offset increases in costs that are necessary for things like pension reform or other costs that might occur. It also might lead to a shift from education spending on higher education. So things like state community colleges and universities might find more funding coming from the school aid fund because lawmakers are trying to figure out ways to reduce pressure on the general fund.
Here's a question I think is probably on most of our minds. Why did legislators make promises that will be so hard to keep? Was there an assumption that the tax revenues would be growing at a rate faster than they have been?
Well, there are a couple of things that factor into it. One is that there has been a little bit higher expectations, I think, than what reality has shown to give. As seen in the personal property tax reform funding, there has been a decline in expectations in terms of what revenues will be available from things like lightening of Michigan business tax credits, where there just isn't as much money available as there once thought there was. Highway funding is another example where initially they expected higher economic growth to be able to cut funding. So I do think that there is a lot of expectations that if good expectations are not met, then there is a little bit more of a problem. When predicting that far ahead, when you have everything based on expectations, if one or two things don't go the way you think they will, it can create a little bit of a problem within the budget.
Is there any evidence of a level of economic growth that Michigan has experienced from the various business tax credits? Do we know what that is?
Um,
I'm not entirely sure. The report didn't dig much into the effects of the business tax credits on economic growth, partially because that's not as relevant to the question of revenue. Um, so I wouldn't feel comfortable saying either way if tax credits are causing economic growth.
Similarly, programs like Medicaid Expansion that bring in significant amounts of federal money in addition to state spending have been shown to create jobs and sustain additional economic growth. Would that affect revenues down the line if those funds were taken away?
Certainly, to the extent that any programs have generated economic activity, removal will definitely have negative impacts on tax collection, as if more people are sick, there's generally less economic activity for the state to generate revenue off of. So to the extent which programs do benefit the economy, there could be some additional effects from cutting them.
Looks like that's all the questions that we've had today. Thank you, Jordan, for a great presentation. If you have any questions about today's material that we didn't get to, please feel free to send us the question via email and we'll get back to you as soon as possible. Finally, just a reminder, you will receive another email soliciting feedback on today's webinar for those questions, so we look forward to any of your comments and feedback. Have a wonderful day.